So in the case of Europe, there are several factors that I think are compelling at this particular point. The first is that Europe is experiencing a growth recovery. First part of the year was soft. Second part of the year we think is going to be better. You already see Citi economic surprise indices, for example, for Europe picking up quite sharply, while the US economic surprise index is coming down. So we think European growth second half of the year is going to be better. We think it's going to be assisted by the tailwind of a weak euro. So the euro was strong in 2017, it's been weaker in 2018. When you get into the second half of the year, that weak euro will support European exports, will support European growth, and we think that's a second important factor. The third factor for Europe more broadly is valuation. The market itself, not just financials, but broadly speaking, the European equity market is attractively valued. And then finally, I would point out that equity outflows from Europe have been significant. I think there was a press report today, something like 55 billion in net outflows from European equity funds over the last 4 or 5 months. And I've seen other statistics suggesting that European equities have had net outflows for something like the last 40 weeks. So Europe has clearly been sold. The currency is cheap, the economy is recovering, valuations are attractive. So all that leads us to Europe.
And taking all of that information and bringing it all together, what vehicle are you looking at as far as executing a trade?
Well, one of the vehicles we like a lot at this particular moment is the European financials, symbol EUFN. And we like the financials again for a number of reasons. First, they should be a big beneficiary of that economic growth in several different manners. As the economy recovers and grows, we would expect interest rates to rise, right? 10-year Bund yields, which is a German government bond, yield about 45 basis points. 45 basis points, right? The 10-year US Treasury yields something like close to 3%. So obviously, European interest rates are very depressed. So should the economy continue to recover, we would expect interest rates to rise, and that would really help the banks because it will allow them to make money on the spread. Right now, that spread is dramatically compressed, and so the banks are struggling with their profitability.